It was September 2008, a month that would go down in history as the beginning of one of the most tumultuous periods in modern financial history. The world watched in disbelief as the financial markets began to unravel. News channels were flooded with images of frantic traders and worried investors. One of America's oldest investment banks, Lehman Brothers, filed for bankruptcy. This was not just a corporate failure, it was a seismic event that sent shockwaves through the global economy. This wasn't just another business failure, it was a sign of deeper systemic issues within the financial system. A warning that the era of easy money and unchecked risk was coming to a catastrophic end. The global financial system was on the verge of collapse. Stock markets plummeted, banks teetered on the brink of insolvency, and governments scrambled to respond. How did this happen? The answer, in short, is greed and a whole lot of risky bets. Financial institutions have been engaging in increasingly reckless behavior, driven by the pursuit of ever greater profits. Imagine a giant game of musical chairs, except the music is the housing market, and the chairs are, well, actual houses. As long as the music played, everyone was happy, buying and selling homes at ever-increasing prices. For years the music played on, and everyone seemed to be winning. Home prices soared, and it seemed like the good times would never end. Houses were being bought and sold at record prices. It was a seller's market, and everyone wanted a piece of the action. Banks were lending money to anyone who could fog a mirror. Mortgages were handed out with little regard for the borrower's ability to repay. It was a recipe for disaster. But then the music stopped. The housing bubble burst, and the reality of the situation came crashing down. And suddenly there weren't enough chairs for everyone. Homeowners found themselves underwater, owing more on their mortgages than their homes were worth. Foreclosures skyrocketed. This is the story of the 2008 financial crisis, a story of risk, greed, and the devastating consequences that followed. It was a wake-up call for the world, a stark reminder of the dangers of unchecked financial speculation and the need for greater oversight and regulation. In the early 2000s, things were good, really good. The economy was thriving, and there was a sense of optimism in the air. People were confident about their financial futures, and it seemed like nothing could go wrong. The American economy was booming, people had jobs, interest rates were low. It was a perfect storm of economic prosperity. Businesses were expanding, and consumer confidence was at an all-time high. The stock market was reaching new heights, and everyone seemed to be benefiting. And the housing market, it was on fire. Homes were being bought and sold at record speeds. The demand for real estate was insatiable, and prices were climbing higher and higher. It was a seller's market, and everyone wanted a piece of the action. House prices were skyrocketing, but no one seemed to think it was a problem. In fact, rising prices were seen as a sign of a healthy economy. People believed that investing in real estate was a surefire way to build wealth. The mantra was, buy now or miss out forever. After all, what goes up must come down, right? Wrong. The general consensus was that the housing market would continue to rise indefinitely. People were convinced that the value of their homes would only increase, providing them with a secure financial future. At least that's what people convinced themselves of. They ignored the warning signs and continued to pour money into the housing market. It was a classic case of irrational exuberance where optimism overshadowed reality. They thought the good times would last forever. Celebrations were in full swing and the future looked bright. People were making plans based on the assumption that the economic boom would never end. Banks were eager to lend money, even to people who probably couldn't afford to repay it. The lending standards were relaxed and almost anyone could get a mortgage. It was a time of easy credit and banks were more than willing to take the risk. Why? Because as long as house prices kept going up, everyone thought they were making money. The belief was that the rising tide would lift all boats. Homeowners, investors, and banks all felt like they were on the winning side. It was like a giant game of hot potato with mortgages being passed around like they were going out of style. The risk was being shuffled from one party to another, and no one wanted to be the last one holding the mortgage when the music stopped. But for now, the game continued, and everyone was eager to play. Now let's talk about those mortgages, specifically subprime mortgages. These were loans given to borrowers with poor credit histories. People who were considered a higher risk of defaulting. Think of it like giving a credit card to someone who already has a mountain of debt. But banks didn't care. They bundled these risky mortgages together and sold them off to investors. They even gave them fancy names like mortgage-backed securities to make them sound less scary. It was like putting lipstick on a pig. Sure, it looked a little better, but it was still a pig, and in this case, a very risky pig. Section 4. Mortgage-backed securities, a recipe for disaster. These mortgage-backed securities were sold all over the world. Investors, eager for higher returns, gobbled them up like candy. They believed these investments were safe because, after all, they were backed by mortgages. What could go wrong? Well, a lot, as it turned out. When house prices finally stopped rising and started to fall, people began to default on their mortgages. And since these mortgages were bundled together, the entire system started to unravel. It was like a house of cards, and someone had just pulled out the bottom card. Section 5, playing with fire credit default swaps. But wait, it gets worse. Enter credit default swaps. These financial instruments were supposed to act as a form of insurance against the default of debt, particularly mortgage-backed securities. However, they quickly became a tool for rampant speculation. Imagine you're at a casino and you place a bet on whether the roulette wheel will land on red or black. The thrill, the risk, the potential reward, it's all part of the game. Now imagine you can bet on someone else's bet. You're not just gambling on the outcome of the wheel, but on the decisions and luck of other players. This adds another layer of complexity and risk. That's basically what a credit default swap is. It's a bet on a bet, a financial agreement where one party pays another if a borrower defaults on a loan. But unlike traditional insurance, you don't need to own the underlying asset to buy a credit default swap. Banks and hedge funds were making huge bets on these mortgage-backed securities. They saw an opportunity to profit from the housing market without actually owning any property. It was a high-stakes game with enormous sums of money on the line. They were essentially gambling on whether people would or wouldn't be able to pay their mortgages. If homeowners defaulted, the holders of credit default swaps would cash in. If not, they'd lose their bet. And just like in a casino, the house always wins. The financial institutions that created and traded these swaps were raking in profits, seemingly invincible. Except in this case, the house was the financial system, and when it started losing, everyone lost. The collapse of the housing market triggered a chain reaction, leading to massive financial losses, bankruptcies, and a global economic crisis. The very instruments designed to mitigate risk had amplified it, leaving devastation in their wake. Section 6, the domino effect from Wall Street to Main Street. The collapse of Lehman Brothers was like the first domino to fall. Panic spread through the financial system. Banks stopped lending to each other. Credit markets froze. Businesses couldn't get the loans they needed to operate. And just like that, the global economy went into a tailspin. This wasn't just a problem for Wall Street bankers. It affected everyone. People lost their jobs, families lost their homes, the retirement savings of millions were wiped out. It was the worst economic crisis since the Great Depression.